the morning of December 11th, 2008, federal agents arrived at a Manhattan apartment on East 64th Street. They were not there because of a tip from a regulator, or because a bank had raised an alarm, or because an audit had finally caught something it should have caught years earlier. They were there because the man who lived inside had called his sons the previous evening and told them, in plain terms, that everything was a lie. The number he gave them was $64.8 billion. That was the stated value of client accounts at Bernard L. Madoff Investment Securities. The actual value of those accounts was close to zero. What followed was the largest Ponzi scheme ever prosecuted in United States history, and the most preventable. Bernard Lawrence Madoff founded his broker-dealer firm in 1960 with $5,000 earned from installing sprinkler systems and working as a lifeguard. That detail, repeated in countless profiles over the decades, became part of the mythology, the self-made outsider who built his way into the most exclusive corridors of American finance. By the late 1980s, Madoff Securities was one of the largest market makers on Wall Street, handling a substantial share of daily order flow on the New York Stock Exchange. The firm was a legitimate and respected operation. That legitimacy became the architecture of the fraud. The investment advisory side of the business was kept deliberately separate, housed on a different floor of the Lipstick Building in Midtown Manhattan, staffed by a small team and almost entirely invisible to regulators and counterparties who interacted with the broker-dealer below. Clients were not solicited through advertising. They were introduced through a network of feeder funds, country clubs, and Jewish philanthropic organizations. Access felt like a privilege. The strategy Madoff described, a split-strike conversion, buying large-cap stocks while simultaneously selling call options and buying put options to limit downside, was plausible enough on its surface to satisfy most investors who bothered to ask. The returns he reported were not spectacular by the standards of the era's hedge fund boom. They were something more seductive than spectacular. They were consistent, year after year, through bull markets and bear markets, through the crash of 1987 and the dot-com collapse of 2000 and 2001. Madoff's accounts showed steady, single-digit to low double-digit annual gains. Volatility, for his clients, appeared not to exist. Institutional feeder funds, including Fairfield Century, Kinggate Global, and Tremont Group, channeled billions into the strategy. Fairfield Century alone had placed approximately $7.3 billion with Madoff by the time the scheme ended, according to subsequent court filings. European banks, charitable foundations, pension funds, and individual retirees across multiple continents had all been drawn in by the same quiet promise. Steady, reliable returns, managed by a man who had helped build the modern market. What none of them knew was that the trading Madoff described was never happening. Harry Markopolos was a financial analyst and fraud investigator working for a rival options trading firm in Boston when a colleague asked him to reverse engineer Madoff's strategy. The year was 1999. Markopolos later testified before the United States Senate that it took him approximately 4 hours to determine that the reported returns could not have been achieved through the stated split-strike conversion strategy. The options market, he calculated, was not large enough to support the volume of trades Madoff would have needed to execute. The positions simply did not exist. In May 2000, Markopolos submitted his first written complaint to the Securities and Exchange Commission's Boston regional office. It was not acted upon. He submitted a revised and substantially more detailed analysis in October 2001. It was not acted upon. In 2005, he submitted a 21-page document titled, in plain language, "The World's Largest Hedge Fund or is a Fraud." That document laid out 29 red flags, including the impossibility of the options volume, the use of a small and obscure accounting firm to audit a multi-billion-dollar operation, and the fact that Madoff's strategy should have produced losses in certain market conditions where it instead reported gains. The SEC's New York office opened a preliminary inquiry, but did not pursue it to examination of Madoff's actual trading records. Markopolos submitted further information in 2007 and 2008. In total, across 9 years, the warnings went unheeded. The SEC's own Office of Inspector General, in a report released in August 2009, examined the agency's handling of the Madoff complaints in detail. The report concluded that the SEC had received 6 substantive complaints or referrals about Madoff between 1992 and 2008, and had conducted 2 examinations and 2 investigations, none of which had uncovered the fraud. The OIG found that examination staff had failed to verify whether Madoff was actually executing trades by checking with the depository trust company, the central clearinghouse that would have held records of any legitimate transactions. That single verification step, had it been taken at any point in the 9 years of complaints, would have ended the scheme. Meanwhile, the scheme was growing. Client statements showed balances that bore no relationship to any real assets. New money from incoming investors was used to pay redemptions from those who withdrew. The operation required a continuous inflow of capital to sustain the fiction, and for decades that inflow never stopped. Until, in the autumn of 2008, it did. The global financial crisis of 2008 did not cause the Madoff fraud. It ended it. As credit markets seized and equity portfolios collapsed across the industry, investors of all kinds moved to reduce risk and raise cash. Redemption requests flooded into feeder funds, which in turn sought to withdraw capital from Madoff. According to court documents and subsequent trustee reports, Madoff faced approximately $7 billion in redemption requests in November 2008 alone. The firm held in reality a fraction of that sum in actual liquid assets. On December 9, 2008, Bernard Madoff told his brother Peter that the investment advisory business was essentially a giant Ponzi scheme. The following evening, December 10th, he summoned his sons, Mark and Andrew, both of whom worked in the firm's legitimate trading operations, to his apartment. He told them he was finished, that he had nothing, and that the advisory business had been a fraud for years. According to their subsequent account, relayed through their attorney, Mark and Andrew Madoff contacted a lawyer that same night. The lawyer contacted federal authorities the following morning. FBI agents arrived at Madoff's apartment on the morning of December 11th, 2008. According to the criminal complaint, when asked by the agents if there was an innocent explanation, Madoff replied that there was not, that he had paid investors with money that was not there, that he knew what he had done was wrong, and that he was, in his own words, finished. He was arrested that morning. The scale of what investigators found was staggering in its simplicity. The entire investment advisory operation was run out of a single floor. Trades were fabricated on paper. Client statements were generated by a computer system that produced fictional confirmations of fictional transactions. The firm's auditor, Freeling and Horowitz, operated from a small office in New City, New York, with a single active accountant. It had not conducted a genuine audit of Madoff's investment advisory business. David Freeling later pleaded guilty to securities fraud, investment advisor fraud, and filing false audit reports. On March 12, 2009, Bernard Madoff appeared in federal court in Manhattan and pleaded guilty to 11 federal felony counts, including securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering, perjury, making false filings with the SEC, and theft from an employee benefit plan. He was sentenced on June 29, 2009, to 150 years in federal prison. The judge, Denny Chin, noted that the fraud was, quote, extraordinarily evil. The court-appointed trustee Irving Picard, acting under the Securities Investor Protection Act, began the process of recovering assets for victims almost immediately after Madoff's arrest. The work would take more than a decade. As of filings through 2023, Picard's office had recovered and distributed approximately $14.7 billion to eligible claimants, a recovery rate that, while substantial relative to most fraud cases, still represents a fraction of the stated losses and leaves the question of inflation and opportunity cost entirely unaddressed. The human dimension of the losses was severe and specific. The Elie Wiesel Foundation for Humanity lost the majority of its assets. Yeshiva University, Hadassah, and numerous other Jewish charitable organizations suffered losses that altered their operations for years. Individual retirees who had placed lifetime savings with Madoff-linked feeder funds found their accounts empty. The SIPC recovery process required claimants to prove their net investment, the difference between what they had deposited and what they had withdrawn over the years, rather than the fictitious balances shown on their statements. For many long-term investors, this distinction was devastating. Paper gains they had believed real for decades simply vanished from the calculation. The feeder fund operators faced their own legal consequences. Fairfield Greenwich Group reached a settlement of approximately $80 million with the SEC in 2012, with the SEC finding that Fairfield had made materially false and misleading statements to investors about its due diligence of Madoff. Separately, Fairfield settled civil claims brought by Picard's office. Ezra Merkin, a prominent fund manager who had channeled client money to Madoff through several funds, reached a settlement of $410 million in a case brought by the New York Attorney General's office, without admitting or denying the underlying findings. The SEC undertook its own institutional reckoning. The Inspector General's 2009 report was followed by structural reforms, including the creation of a dedicated whistleblower office and program under the Dodd-Frank Act of 2010, which established financial incentives and legal protections for individuals who reported securities violations. Harry Markopolos, who had spent 9 years trying to be heard, testified before the Senate Banking Committee in February 2009. His testimony was precise, methodical, and without visible satisfaction. Bernard Madoff remained incarcerated at the Federal Medical Center in Butner, North Carolina. In February 2020, his attorneys filed a compassionate release motion citing terminal kidney disease. The motion was denied by Judge Chin. Madoff died in federal custody on April 14, 2021, at the age of 82. The lesson the record supports is this: a fraud of any size requires not just a perpetrator, but a system of oversight that chooses, through negligence or institutional inertia, not to look, and the cost of that choice is measured in the lives of people who had no reason to know they were in danger.